Welcome to the Retire with Peace podcast, the podcast where we help you create a fulfilling and stress-free retirement. Each week, we bring you expert advice, practical tips, and inspiring stories to help you plan and live your best retirement life. Whether you're nearing retirement or already enjoying your golden years, this podcast is here to support you every step of the way. Let's embark on this journey together and discover how to retire with peace.
Welcome back to the Retire with Peace podcast. As always, I'm your host, Dave Zaegel. This episode is sponsored by CWOs for Hire, which is the retirement planning firm that I co-own. This is one of the times of the year when we bring on new clients. We don't do that year-round, otherwise it'd be kind of crazy. But this is one of the times of year when we do bring on new clients. So if you're looking for help or just have questions, please feel free to reach out to us, and you can visit CWOsforhire.com. Let's talk about the Tax Cuts and Jobs Act. Now that we have a new executive branch coming in, new legislative branch coming in of the government, we really have to address the expiring Tax Cuts and Jobs Act. So to back up, the Tax Cuts and Jobs Act was put into place back in 2017, and it is set to expire, at least a lot of pieces of it, not everything, but a lot of pieces of it, they're set to expire at the end of 2025. This is really important because regardless of who was elected this year, they were going to have to address the fact that the Tax Cuts and Jobs Act is set to expire. So something was going to have to be done. Otherwise, everything just reverted back to the way it was. And I don't think really either party wanted everything to revert back the way it was. So something was going to happen in 2025, regardless of who got elected. It was just a matter of what would happen. And so now that we know who's coming in, we have some idea of the changes or what's going to be kept versus what won't be changed. We have some idea of that. But I want to caution against making too many assumptions at this point in time. I've been hearing a lot of people speaking about what's going to be part of this new tax regime or tax changes, however you want to term it. And they've been speaking with such certainty about this will be put in place and this will be put in place and this will be changed and this will be kept. I really hesitate to make any assumptions at this point. It's way too early. I think that a lot of people have listened to both President Trump and also people around him and some people in Congress, and they've said, here's what we're going to do with the tax laws, but we can't assume that that's actually what's going to end up happening. There's a ton more negotiation that goes into this, and we've seen this really the previous three presidential changes. They've come in with their party controlling the legislative branch, and they still have not gotten everything that they wanted with their major pieces of legislation. So we can't just assume, oh, well, this one party's in charge, therefore everything's just going to go smoothly. Everything they say they're going to do will happen. It just isn't the case. There's going to be a lot of negotiation. We're already seeing that. We're seeing that with the state and local tax cap. That is an itemized deduction. So they capped state and local tax deduction as an itemized deduction at $10,000 when they put the Tax Cuts and Jobs Act in place. We'll talk about this in a second even more. So there's a lot of pushback from especially congressmen and congresswomen in New York, California, other high tax states that are saying, no, we're going to hold up any tax bill unless there's a substantially higher cap or no cap at all on the state and local income taxes. So there's always going to be negotiation, even within a party, in order to get this done. So when you're hearing stuff, we cannot assume yet that everything is set in stone, regardless of who's saying what and what's going to happen. So in light of that, instead of making bold predictions about this, let's take a look at the key pieces that are set to expire. That way, you'll have an understanding of what changes are being made or not, and what potentially could happen, and what those impacts would be based upon these key things that are set to expire. We're not going to go into all of them because we'd be here all day, but let's cover those that are more specific to retirement planning and those who are going to be in retirement soon or might be in retirement currently. So there's still a number of those things. Let's start covering each of them. I would say in order, but we'll just take them one at a time here. So first thing on a basic level is that tax rates would go higher. So there's different tax brackets right now. There's 10, 12, 15, 22, 24, 32, 35, 37. So just to confuse everybody, there's a whole bunch of tax brackets, and that's what they are now. Some of them will stay the same, and some of them will go a couple of percent higher. So the 10% stays 10%. The 12% would go to 15. The 22% would go to 25. The 24% would go to 28. The 32 and 35% tax brackets would stay the same. And the 37% would go up to 39.6. So it's a blend of some go up, some stay the same because maybe they were never increased in the first place, never decreased in the first place. So some will go up, some will stay the same. It's a mix, but overall, the tax rates would just move higher. So that's one thing to watch is what do they do with the tax rates and tax brackets? Again, we don't know that yet. But if nothing happens, then they are set to go higher starting on January 1st of 2026. Second thing is that the standard deduction would be much lower, roughly half. Essentially, when the Tax Cuts and Jobs Act was put in place, they doubled the standard deduction. So let's back up on that one a little bit because not everybody knows what that means. So on your tax return, you get the higher of a standard deduction or your itemized deduction. And your itemized deduction are state and local income taxes, mortgage insurance, and charitable donations. There's some other stuff that's not likely, but those are the three biggies: the mortgage interest, charitable donations, and state and local income taxes. So if the Tax Cuts and Jobs Act were just let to expire, that the standard deduction would get cut in half. Now, there's a couple other pieces to that, but at a basic level, what that means is more people are going to wind up itemizing their deductions than taking the standard deduction. When they did double that standard deduction back in 2017, that meant that fewer people had to itemize deductions. They just got a greater benefit from taking the standard deduction. On top of that, we mentioned earlier the state and local income tax deduction. Under the Tax Cuts and Jobs Act, that was capped at $10,000 per year for a married filing jointly tax return. If the Tax Cuts and Jobs Act goes away, there is no more cap. And that cap is a very politically sensitive, and not even just politically sensitive, it just depends where you live and what your income is. That can be a very sensitive topic in terms of who wants what. Because in a lot of high tax states, that hurt worse than the tax cut rates benefited. Let's put it that way. So even though rates went down for a lot of people in high tax states, they actually wound up in a worse position because they were no longer able to deduct those state and local income taxes to the amount that they could in the past. So even though the standard deduction went up, them losing that state and local income tax was a big deal. Again, who knows what's going to happen in 2025 when they look at the tax laws, but just know that if the Tax Cuts and Jobs Act expires, there's no longer a cap on state and local income taxes. So those in the high tax states will be very happy to see that cap go away. Third thing, there would no longer be a business income tax deduction. So when the Tax Cuts and Jobs Act was passed, they lowered the rate for C corporations for their income tax. They had to do something for partnerships, S corporations, all of which flow through to a personal tax return. So those partnership S corporations, those entity structures don't have their own tax rate. All the income gets passed through to the owners personally, and they pay taxes according to that income on their tax return. So to try to level out the fact that they dropped the rate for C corporations, they had to do something on the individual tax returns. So they put in what's called a business income tax deduction. Not going to go through all the details of what that is, because there's actually a lot that goes into it. But just know that that goes away. That deduction is gone if the Tax Cuts and Jobs Act does expire. Interesting note on that is that we just mentioned that they lowered the tax rate for C corporations, and in doing so, they had to do something for the individual, and they put in that business income tax deduction. That business income tax deduction goes away. The lower rate for the C corporation actually does not go away. It does not expire as part of the Tax Cuts and Jobs Act. So it'd be an interesting, unbalanced situation where C corporations are getting a lot more benefit. I don't see that piece expiring because that would just cause a ruckus. That'd be a pretty big uproar to have such a benefit of having a C corporation. But again, we have to not make too bold of predictions. We just need to understand what pieces are going away if nothing's done about the Tax Cuts and Jobs Act. Something will be done. We just don't know what. Fourth thing, the personal exemptions would come back. So if anyone old enough to remember exemptions from 10 years ago, that used to just be an amount that you got on your tax return for effectively being able to fog up a mirror. It just, based on the number of people on your tax return, yes, there were some income limits and all that, but you could just get a personal exemption on your tax return, kind of like an extra deduction, for lack of a better way to phrase that. They eliminated that with the Tax Cuts and Jobs Act. I'm not too sure it was ever really necessary to have it on there other than having another deduction, but I doubt that would come back, but we'll see. Just letting you know that that would come back. Those personal exemptions would return if the Tax Cuts and Jobs Act did expire. Next one is a big one for a lot of people, and that is the child tax credit would be a lot lower, essentially half. So if you have a child, right now you're getting about $2,000. It kind of depends on age, but for most children, you're going to get $2,000 of a tax credit per child. So not a deduction before you're calculating income, just a straight credit back on your tax return per child. Cutting that in half would be pretty significant for a lot of people who have children still. But that's what would happen if the Tax Cuts and Jobs Act were set to expire. Now, there's a pretty big and relatively bipartisan push to actually have the child tax credit be higher. And interestingly, that was something that was holding up the Tax Cuts and Jobs Act. There were, I believe, two senators, I believe Rubio was one of them, back when the Tax Cuts and Jobs Act was being put in place. There were two senators that were holding things up because they were not going to be on board unless the child tax credit was increased. So that child tax credit actually went up when the Tax Cuts and Jobs Act was passed. That would just go right back down unless Congress does something about it. Like I said, no big prediction, but there is some bipartisan support for making sure that that child tax credit is there and potentially even higher than it is right now. Next thing is deductions for asset management and tax preparation fees. So those were gone when the Tax Cuts and Jobs Act passed, and those used to be another itemized deduction that you could take. So especially for people who were in retirement, where they had built up a good chunk of assets, they were paying somebody to manage that, they were paying they're paying fees for tax return preparation, things like that. Some of that oftentimes could be deducted as an itemized deduction on their tax return. That went away under the Tax Cuts and Jobs Act. So that would come back if the Tax Cuts and Jobs Act were just allowed to expire. So that is not a huge thing, but for some retirees, that could be meaningful. So I wanted to mention that as we're talking about retirement planning. Last thing, estate taxes. So there is an exemption amount whenever you die, there's an amount that is exempt from estate taxes. Pretty high right now. Most people are under the exemption limit with no problem. If you have a lot of money, that's great. And you will not be fully exempt, but the vast majority of people are still fitting underneath the estate tax exemption amount because it's so high right now. They effectively doubled it back when they put the Tax Cuts and Jobs Act in place. If the Tax Cuts and Jobs Act were just allowed to expire, that would get cut back in half. A lot of people would still fit under the exemption amount, but cutting that in half would be a big deal for a lot of people. Part of the reason and the justification for having a higher estate tax amount comes from things like selling a business, for example. So if somebody were to pass away and they owned a business that was a substantial size, it's hard to pass that on to beneficiaries or other people that run the business if they have to turn around and pay a big estate tax on that inheritance, because now they have to figure out where to come up with cash. Like, the business has a value, and that's great, but you can't always get extra money out of the business to pay the taxes on what you just inherited. So it can cause a lot of issues in transitioning a business. That's just one issue with having a lower estate tax exemption. I'm not saying good or bad. I'm just pointing out that if you start lowering the estate tax exemption, could cause some issues with business owners. But still, most individuals, most couples will fit under the old estate tax exemption just fine. But we'll see what they do with that. There's still no word yet on exactly what they're going to do, but that's just another thing that would change if the Tax Cut and Jobs Act were set to expire. This episode's been a little longer than usual, so thanks for hanging in there. But I just wanted to go through that list of things so that way you will understand from a retirement planning perspective, what does it mean when we hear about the Tax Cuts and Jobs Act being set to expire at the end of this year, and all this talk about what to do with tax policy that we're going to be hearing in 2025. Now you'll know some of the key points and things that they will be focused on, because they have to focus on them. Otherwise, it just reverts back to what it was. So now you know tax rates would be higher, standard deduction would be half, no more SALT cap, state and local tax, that's an acronym, state and local tax SALT cap, no more business income tax deduction, personal exemptions would come back, child tax credit would be lower, the estate tax exemption would be lower, and deductions for asset management and tax prep fees would be back in play. Those are the big items in the retirement planning realm. There's more stuff out there, but that's enough for today to understand what some of the big differences would be if the Tax Cuts and Jobs Act were just allowed to expire. I don't see that happening. I think they'll address all or most of this stuff, but just know that those are going to be some of the key items that we're going to be hearing about in terms of tax legislation in 2025. Thanks so much for tuning into this episode. I really appreciate your support and hope you found value in the conversation. If you enjoyed it, be sure to subscribe, leave a review, and share it with someone who might benefit from it. Your feedback helps keep the show growing. Until next time, take care and stay strong as we learn to retire with peace.